Hey guys, welcome to the 10X Academy. I am your host JR, and in today's video, I'll be discussing a simple guide on how to invest in the stock market. This strategy uses two of the 7 primary flows of income, primarily dividend income and capital gains. And as we all know, creating passive recurring income is the key to creating wealth. Stay tuned till the end of the video where I will go over 9 key points to use while investing in stocks to help grow your portfolio from scratch to a freedom-sustaining passive income producing flow to help you reach financial independence and retire early. What is investing? This video is based on Ryan Scribner's Stock Market for Beginners, How to Invest as a Complete Beginner in 2019. I wanted to give a shout out to Ryan. Please go check out his video. Link is in the description. Now let's talk about investing versus trading. Trading involves buying and selling stocks frequently to try and make a profit from a sale. It is often done in a short period of time and based on speculation or trading patterns stocks experience for a given period of time. Over 99% of active traders lose money over time. Whether either for a short duration or a longer period of time, the odds of beating the market are not good. In fact, for the last 15 years, only around 7% of mutual funds that are actively managed by professional fund managers beat the S&P 500. 93% did not, and these are professionals. Portfolios are often compared against the S&P 500, which is a market capitalization weighted index of the 500 largest U.S. publicly traded companies. To beat the S&P 500 means your stock portfolio is generating greater returns for a period of time versus the S&P 500. The average return of the S&P 500 over the last 90 years has been 9.8% per year. However, some years has seen big losses, with the biggest loss being around 47%. However, on average, the return is 9.8% overall. Now let's talk about what investing really is. According to Benjamin Graham, the father of value investing, an investment is a placement of capital on an asset upon which through thorough analysis promises safety of the principal invested and a satisfactory return on the investment. Note that true investing is not speculative. Speculation is defined as 1. Not enough analysis or research done. 2. There is significant downside to your investment. Or 3. An unreasonable return is hoped for. Finally, return on investment should include 2 key flows of income, which I have discussed in a prior video titled How to Create Multiple Flows of Income. Link is in the description. These 2 flows are dividend income and capital gains. Dividend income is earned from stocks or mutual funds that pay dividends, usually paid quarterly or every 3 months. Risk is higher since assets can depreciate over time. However, losses are tax deductible. Dividend income is more of a long-term strategy play where assets are accumulated slowly and dividends are compounded to grow the investments. Capital gains is when an asset gains value or appreciates over time. In the case of stocks, the value of the stock has gained value over time. In order to take advantage of capital gains and avoid heavy taxation of this type of income, stocks should generally be held for at least 1 year. Capital gains provides the lowest tax rate for this type of income, similar to dividend or rental income. Taking advantage of both of these types of income while taking advantage of the fundamentals of investing is the key to creating long, sustaining wealth. To summarize, there are 3 critical factors to investing. 1. The time period of investing. 2. The strategy used to invest. And 3. The allocation of principal to invest. These are part of the 9 key steps that should be used to invest in the stock market. I will now go over each of these steps. 1. Buy low, sell high. The valuation of a stock usually is volatile over time. The price goes up and it goes down. There are generally 3 cycles to each wave. In the first wave, early investors are the first ones to buy. These may be preferred investors or people that work at the company, for example. The second wave usually involves institutional investors or fund managers. The third wave is when the broad public or retail investors come in. This third wave can also be broken up into different waves, including the initial bull run where the stock price shoots up, then it plateaus, followed by an eventual significant drop in price. These cycles are repeated over and over again. The key for an investor is to buy low and sell high. Buy when no one is buying or when the value of the stock is at a significant value compared to its all-time highs, or 52-week high, for example. There are metrics that can be used to know when to buy and when to sell. However, for long-term investors, buying at a relatively low price and holding on to the stock, if it is a solid business that will be around for many years, provides greater value than continuously buying and selling stocks. Especially if you can take advantage of the two forms of income flows it can provide, dividend income and capital gains. Ideally, you want the stock to appreciate over time in its value and pay an increasing dividend that is higher than the rate of inflation. This is the golden ticket to providing a long sustained form of income for as long as you're willing to hold the asset. 2. Ignore the noise. Activity and noise is what makes up Wall Street. The more activity there is buying and selling, the more money Wall Street makes. Wall Street loves mass media attention and doomsday news. As an investor, your job is to ignore the mass media and the news. Do your due diligence and stick with your plan of investing. With that, keep in mind that whenever there are overreactions, such as a certain company doesn't meet their expected earnings, and the stock drops in price significantly, this could be an opportunity to buy in. The key point here is to have a strategy that is consistent, repeatable, and scalable. That is the secret to creating wealth investing in the stock market. 3. Stock market cycles. The stock market itself, as well as individual stocks, swing in cycles. Stock prices could swing steeply where the price drops significantly, usually causing massive fear for investors of that particular stock or the market in general. This is where you, as an investor, should consider investing in a particular stock you have done your due diligence on. You want to buy at maximum value price, not minimum value when the stock is overvalued. Likewise, stock prices could swing up sharply where the price increases significantly. This causes buyer frenzy and the emotional term FOMO kicks in. FOMO stands for fear of missing out, where buyers with fear of missing out are willing to pay any price for a stock just to hold it while it goes up. They don't want to miss out on that explosive growth in price the stock has experienced. Oftentimes, however, they end up buying the stock at the top, where it subsequently plateaus and eventually drops in price, sometimes drastically. Then they sell at a loss because they can't bear to see it keep dropping. And of course, once they sell, it goes back up and even higher than where it was before. FOMO kicks in and they buy again at an even higher price. And this vicious cycle goes on and on. As a savvy investor, you buy when it is at maximum value and sell it if you wish to when it is overvalued. Then you rinse and repeat. In general, timing the market is impossible. The prices of commodities are constantly moving. It's like trying to hit a moving target with your eyes closed. The best attitude or action to have when investing is this: time in the market is better than trying to time the market. 4. Invest in what you know. Always invest in what you're familiar with. When investing in a company, have a basic knowledge of how the business works, how the company makes money, and a familiarity with the products or services they sell is a big plus. When you invest in stocks, you want to keep things very simple. Over-investing or getting into too many positions oftentimes leads to confusion and not being able to keep up with all the news for each company you're invested in. Invest in simple companies you recognize and understand, such as Apple, Bank of America, Coca-Cola, Delta Airlines, Exxon are just a few. 5. Diversification. It is helpful when selecting stocks you'd like to invest in to diversify your portfolio of stocks. Diversification using several strategies helps mitigate losses when the economy takes a downturn or certain sectors have downturns, or even when a particular business has a bad quarter or a bad year. Now I will go into different strategies of diversification to apply to your portfolio to help mitigate risk when selecting stocks. Sector diversification. There are 10 main sectors in the stock market. Energy, which is oil, gas, and charcoal. Examples of this sector are Exxon, Shell, Chevron, and BP. Basic materials, which consist of chemical, metals, and construction materials. Examples of this are Dow, DuPont, Valvoline, and Sherwin-Williams. Industrials, which is a defense sector, machinery, airlines, constructions, and manufacturing. Some companies in this sector include Boeing, 3M, UPS, Delta, and Caterpillar. Consumer discretionaries, retailers, apparel, restaurants, autos, and hotels. Examples of these are Amazon, Home Depot, GM, Starbucks, and Target. Consumer staples, which are food, beverage, and tobacco. Some companies in this sector include Coca-Cola, Procter & Gamble, Kraft Heinz, and Philip Morris. Healthcare sector, which includes pharma and healthcare equipment and services. Some companies in this sector include Johnson & Johnson, Pfizer, Merck, and United Health. The financial sector, which are banks and insurance. Companies in this sector include JP Morgan, Bank of America, Goldman Sachs. The information technology sector, which is commonly known as the tech sector. Some companies in this sector include Apple, Intel, Microsoft, Facebook, and Google. Communications sector, which consists of companies like AT&T, T-Mobile, and Netflix. The utilities sector, which includes electric, water, gas utilities. Some companies in this sector include the Duke Energy, NextEra, and PG&E. And finally, the real estate sector, which includes REITs and real estate developers. Some companies in this sector include Simon Property Group and Realty Income Corp. Regional diversification. Diversifying both domestic and international stocks is a great way to mitigate risk across world economies. Two great funds to build upon your diversification strategies are the Vanguard International High Dividend Yield ETF, or VYMI ticker symbol, and the Vanguard Total International Stock ETF, stock ticker symbol VXUS. These are both great dividend ETFs while concentrating on non-US stocks to give your portfolio an international bounce. Market cap diversification. Market capitalization is defined as the value of all outstanding shares of a corporation times the market price. Market capitalization diversification involves diversifying your portfolio across the different market caps, small, medium, and large. Small cap stocks have a market capitalization between $250 million and $2 billion. Medium cap stocks have a market capitalization between $2 billion and $10 billion. And large cap stocks have a market capitalization greater than $10 billion. The smaller the market cap, the more volatility the stocks experience. But with more volatility comes the potential for more market gains. Ideally, you would want some exposure in your portfolio to small and mid caps, but concentrate the majority of your portfolio on large caps that are more stable. Market caps can also be diversified further between US and international. Some small and medium US market cap ETFs that can provide good diversification include the Wisdom Tree US Small Cap and Medium Cap Dividend Funds, ticker symbols DES and DON respectively. Planning out your investment strategy. There are 4 main points you want to consider when working on your investment strategy, either for a company you want to invest in or overall for your portfolio. 1. What is the price you're willing to pay for the stock? Buy at maximum value, not when it is overpriced. 2. What is your investment time? Is it a week, a year, 10 years, 30 years? This is important to know as it will determine how much you want to invest in this company, as well as the strategy of when to buy and when to sell. 3. What weight will this company have in your portfolio? Do you have diversification employed in your portfolio? 4. What is the thesis for investing in this company? What is their story and how is it relevant to the market? And is it a company you understand and is it an easy business to understand? 7. Value of money. Investing long-term creates greater returns due to compounding interest. Average return of the S&P 500 is roughly 9% per year. Compounding your money, independent of how much you invest, will create a snowball effect where your money will grow exponentially over time. Money compounds from 2 factors: capital appreciation of a stock plus dividend reinvesting. Time is of the essence. The more time you invest, the greater the compound effect. M1 Finance is a stock brokerage app that allows investments in small amounts and fractional shares to be purchased of any stock. M1 Finance also has a rebalance feature where you can rebalance your portfolio at any time to sell shares of stocks you are in profit in and buy more shares that you are down relative to the rest of the positions in your portfolio. Investment of funds or dividend reinvestments automatically get allocated to stocks that are relatively down in your portfolio versus buying more shares of stocks that are up. Click the link in the description to start using M1 Finance and get $10 toward your first stocks when you sign up now. 9. Dollar cost averaging. Dollar cost averaging is a strategy that allows an investor to buy the same dollar amount of an investment on regular intervals. The purchase happens regardless of the asset's price. As the price goes up, you average up, buying less of a stock, but nonetheless still building up your position in that stock. As the price drops, you're averaging down, buying more quantities of the stock, building up your position as well. On average, over time, The appreciation of the stock as well as the dividend reinvestments allow the position to gain value over time, and its value compound over time. Time in the market versus trying to time the market is key in investing. Invest for the long term and compound ROI, or return on investment, which is basically the appreciation of the stocks and the dividends paid out, reinvested. Invest in value, not speculation. Continue to invest capital on a regular basis using dollar cost averaging to make your portfolio grow over time. The ideal appreciation curve of your portfolio over time should look like this. Remember to check out the links in the description to start investing in the stock market using simple to use stock investment apps that are commission free. Thank you for watching this video, and don't forget to subscribe for more wealth creation videos and hit that like button if you enjoy watching content like this.